Hi guys, welcome back to the channel. My name is Dave, and today I want to crack that whip and talk about DIVO. DIVO is the ticker symbol, and this is another income ETF. So we've talked about a few recently. QYLD, JEPI. I figured we're going to go through all these. I'll start categorizing them. Maybe an income ETF is right for you. Maybe it's not. We'll talk about that as well. We're going to put them all in order from my favorite to the one I don't like at all. And we'll talk through all that. We'll keep adding them to this list and see how they hold up. But DIVO is by DIVO. No, I was shocked as well. It's hopeful, but it's not. It's actually by Amplify. Not nearly as exciting, but we'll deal with it. But this is the Amplify Enhanced Dividend Income ETF. A little bit of a mouthful. And I like that they use enhanced, because a couple of weeks ago we talked about JEPI, and we talked about how that's the premium ETF. And this one's the enhanced ETF. So it's a little bit of a competition there, I think. Now, someday I'm going to develop my own, and it's going to be the endgame ETF. I've already decided, and I think that will sell really well. I think I'll do well there. But is this a good income ETF? Should we have one of these in our portfolio? Is this the right one? We're going to talk about all that, see how they hold up against each other. So let's whip it real good, and see how this goes. If that is what you're looking for, please stick around. Whoop. So I always like to point out at the beginning of these reviews for these income ETFs that they're not for everyone. For example, if you're a young person looking for total return, you're probably better off with something like VOO, buy and hold, dollar cost average, buy every single month. You're going to do better over the long run than something like DIVO that pays out a big dividend every month, and you have to pay taxes on it, and you might reinvest it anyway. So in that case, I would recommend not receiving the income, keep it in an ETF. It's probably going to give you a better overall market return as well. Now, if you are a little bit older and you really want some of that income and you want less volatility, then something like DIVO might work out really well for you. So keep that in mind. Do you have a use case for this income? Is there a reason for you to receive it in the first place? If you do, go for it. So as I mentioned, I've done reviews so far of JEPI from JP Morgan and QYLD from Global X. Now these two are clearly 1 and 2 out of 2. I would put JEPI as my number 1, and I put QYLD as a solid number 2. Actually, I would move it down a little bit. I'm going to create some room in between number 1 and number 2 because I'm not a big fan of QYLD, honestly. So we're going to bring that down here a little bit. We're going to create some room because I think some of these other ones are going to fill in the middle a little bit. But again, this is just my personal feeling and the way I look at these. You know, being someone that trades lots of options, I just don't like the way that one necessarily functions. So we'll talk through that as we go through this. But right now, number 1, number 2. So let's pull up the Amplify ETFs website here and take a look at what is in this fund and how it operates. So DIVO, ticker symbol, it's been around for about 5 years, a little bit longer than some of the other ones we've talked about. They're relatively new, but it only has net assets of about $1.6 billion. Now, while that sounds like a lot, it's relatively small in comparison to QYLD and JEPI at this point. The net expense ratio is only 0.55%. That's in the middle. So as a comparison, JEPI is 0.35%, QYLD is 0.6%. So this one's in the middle. And what that means is if you invested $10,000, it would cost you $55 to pay the managers and everybody else behind the scenes here. Over the course of that year, you'd lose about $55 out of that fund, out of your investment. Now, this one is actively managed, so that's really important to understand that you're getting something out of this expense ratio, whereas QYLD is just an automated robot that does its purchasing here. So this one is actively managed, and I like that idea when it comes to an income ETF. Now, it's got 28 holdings, so it is pretty broad. We'll see it. We'll take a look at that, but 28 holdings isn't a whole lot, but it's mainly blue chip stocks. So DIVO, objective and strategy, here's what I'm looking at, is an actively managed ETF, like we talked about, of high-quality, large-cap companies with a history of dividend growth. So they're looking for stocks that have dividend growth. So over a period of time, you should see a little bit more coming out of this fund, along with a tactical covered call strategy on individual stocks, which is similar to what I do on a routine basis every day. So DIVO is strategically designed to offer high levels of total return on a risk-adjusted basis. So sounds pretty good to get started here because I guess as somebody who likes to generate income, selling covered calls, selling puts, that kind of thing, it's very similar to what I do. Now, if we look at the yield here recently, it's right at about 5%, and this does get paid out monthly, just like JEPI and QYLD. But that is a paltry 4.9% compared to the 11.3% currently for QYLD. I get it. But if we compare the two over the last year, take a look at this chart, you're going to see QYLD is down 18.24%, while DIVO is down about 4%. That's a huge difference. Even when you adjust for these dividends, it just doesn't come close. I realize that you like getting that 1% every single month that QYLD promises, but sometimes when I think about that and I look at it, you got to consider the fact that return of capital is involved with that and things like that too. So if you give somebody $1,000 and they give you $1,000 back, that's not a great deal necessarily. So keep that in mind again as we move through this and take a look at yield. And we can scroll down and take a look at their chart here, and you can see the high at the beginning of the year, right around $38 a share, and it dipped all the way down to about $32.80, but that's 14% compared to some individual stocks this year that just got hammered. Not too bad. It's held its value pretty well. It's protected your basis that you've invested in this pretty well, even if you invested at the very tip top at the beginning of the year. Now it's currently sitting at about $35.15. You see the fund holdings here, but we're going to focus on those a little bit more. You can see the sector allocation, pretty broad-based overall. You can see the annual performance and return, and you can pull this up yourself. But when you compare this, like 1, 3, 5-year return here, like this 11.5%, that's going to be very similar to what SPY has returned over that 5-year period. Nearly identical, actually. But the difference has been that this is distributed out a bunch of money, whereas SPY's kept it in the fund. So again, if you don't want to receive this money, don't receive it. You don't have to pay the tax. You buy SPY. But if you want some income, you can at least understand that it's had about the same kind of performance as what we've seen with buying SPY. And here's a quick look at those DIVO distributions. So again, this one pays out every single month, which I know some people love. To me, it doesn't really matter if it's monthly or quarterly, but it is nice to know, because a lot of people pay their bills every single month, and that's what they want to use this for, that it does get paid out that way. Now, they say growth is going to occur because the underlying stocks that are held within this fund are going to grow those dividends. But so far, if you look back 2020, 2019, haven't seen a whole lot of growth. It's kind of been pretty steady though, right around that 13 to 15 cent range. So we'll see if that growth kind of goes, as we move forward. But unless they probably get more aggressive selling more calls, because we'll see that they don't do it against the whole portfolio. They're very selective. They're probably not going to see a huge amount of growth on the dividend side. Okay, so now let's talk about what really matters, and those are the DIVO holdings. And again, they only have I think what was it, 26? But I look at this, and this looks like my portfolio. Bunch of blue chip stocks, good value stocks, right? And then they're selling some covered calls against their position. So the only thing they're missing here is Intel. Now, which is a brilliant move at this point, because I've been talking about Intel and how I like it. And then that last earnings report, that was absolutely horrific. So I've been wrong. Been wrong and wrong before. But I'll address that in another video. I don't want to get in a bad mood, so we'll just skip that for now. But we'll talk. But that was ugly, so ugly. But these, they're bright enough. They don't have Intel in here. But what they do have is, again, I'll go down through here. I own a lot of these. So Chevron, Apple, McDonald's, Visa. I have all those. Home Depot as well. I don't have any United Health Group. Very popular stock though. But Procter & Gamble, Microsoft, Goldman Sachs. These are all great stocks to fill out a portfolio with. Now, as we cruise down here, we see Cisco, we see Duke. So they're very broadly diversified across a lot of different industries. I like that. They got Aflac, and they even got some Verizon, another one that didn't have a great report this month. But down here at the bottom, you're going to see these covered calls that they've been selling. Scroll down through here, and it looks like they got one against UPS, American Express, and Marathon. So they only have 3 right now. And I looked a couple days ago, and they had one with Apple. So that one either expired, they closed it out. Not sure of the situation, but you can see, so they only sell covered calls against a portion of the portfolio to generate some of that income. So during times when they want to be more aggressive, they probably could be. And when they don't think that's a good time to sell covered calls, they're probably not going to. So they're looking at this and they're making that determination. And again, you have this professionally managed by some people that are doing this for you. So if they're doing their job, they're doing it well, then you're going to continue to receive that income. In certain months, that's going to be better. And certain times, it's going to be not as good based on their decision making. So we want those guys to be doing a great job for us. But that's how it works. And like I said, if you were to look in my portfolio, if I was to open it up, it would look very similar to this type of setup with my individual stocks that I hold. And that's why I'm very comfortable with this idea and how they go about generating that income and spinning it off. So after looking at DIVO and doing my research, I've decided that I like this one. It's a pretty good little ETF here if you're looking for some income. So I bought a few shares as kind of an experiment, stick them over here, kind of monitor it for a little while. see how it performs. But I like that they got this small basket of stocks, of non-volatile stocks, right? Nice big blue chips. I think that's going to protect my basis pretty well in this market right now because I'm not real confident going forward right now. So it feels pretty good. At the same time, selling covered calls and spinning off some income that can be paid out to me. That all works pretty well for my personal situation. Now, I can't say if it's right for you, but if you are in the mood, this might be a good one for you if you can survive on just 5%. However, I do know that I have some dividend whores out there that are grabbing their calculator right now. They're saying, but QYLD does 1% a month, and I get it. I get it. You want more because you've been working a long time, you've accumulated some cash, and you want to know, can I live off this? Can I survive going forward? But that doesn't necessarily mean it's the best investment for you. So again, we'll put these in order at the very end of this video. But in that case, if you do like QYLD, what I would probably do is I would split it up. Let's say you have $30,000. Go 10, 10, and 10. Buy some JEPI. Buy some DIVO and some QYLD. You'll get like 4% here, 8% from JEPI, and 12% from QYLD, which is 24% overall. Divided by 3 for 3 different funds gives you 8%. Can you survive on 8%? Will that make it? Will that be able to make ends meet going forward? It might be a better way to do it. Make a soup. Be really diversified, especially when you're looking at income and looking at consistency over time. But just a suggestion or a thought. So now for the moment you've all been waiting for. We only have 3, but it's going to get filled out. So we're going to start. What's our top? Reveal at this moment. Now, you're not going to be that surprised because JEPI is number 1 for me still. It's got a nice yield. It's got a nice setup here with the product. The management team's great over there at JP Morgan. They're doing an outstanding job. Broadly diversified. I like their ELNs. Nice setup. Go for it. And the lowest management fee of all. Coming in number 2, and depending on your situation, you can flop with this, but it's number 2 for me clearly is DIVO. I think this is a great setup. It looks just like my portfolio. Like I said, this is how I like to manage my portfolio. I buy individual stocks, some ETFs. I sell puts and calls against these to try to generate some extra income. In my options portfolio, it looks very similar to like what you might see right here with DIVO. And then number 3, with room to spare. Sorry, guys. QYLD. For the yield whores out there, I get it. You need those. You got to have them. But it's not the best product for me. So it's a clear number 3 with room to spare. We'll see where it ends up at the very end. But I'd love to hear your point of view. Please share it down below, your personal experience and what you like and what you don't like. I'd love to hear it down in the comments. Let me know. So if you like this kind of content, please like and subscribe. If you want to see a certain income ETF, just put it down in the comments. I'll do my best to get around to it. SCHD, not an income ETF, but it's one that I've been asked about a lot. I'll be doing a review on that here soon. I also talk a lot about options trading, individual stocks, all types of investments. So again, please like and subscribe. Now, any questions at all, please ask down below. Really appreciate you watching. Have a great night. Take care. See ya.